Risk, the 1% rule. Millions of people that globally trade the Forex market never really understand the power of risk management. And what they do is they over-risk their trades. And in a sense, they are gambling because they are taking too much risk and not letting the probabilities play out. Now at Guerrilla Trading, we will teach you how to trade professionally. We will teach you how not to gamble and how to limit your risk to only 1% and to maximize your profit using great risk management strategy. Now, this will allow you to focus on the strategy and help psychologically to not get over invested with your emotions while trading. Now, we have a website here which will allow you to calculate your lot size, which will show you exactly how to calculate 1% risk of your trading account. Money management. Now, most new traders that come into the Forex market, what they will worry more about is they will worry about how much money they can make, rather than looking at the risk on the table. Whereas a professional trader will always think about their losses and how they can manage their trades. Okay, now at Guerrilla Trading, we always cap our losses at 1%. So the maximum you can lose is 1% per trade. So if you think about it, you will have to have 100 losses in a row for you to lose your account. Now the great thing about this is you are allowing the probabilities to play out because no one knows when the winners or the losses will come. Now a profitable trader always aims to win more when they are right and to lose less when they are wrong. And this is why we always stick to the 1% risk. Slippage. What is slippage? Well, slippage occurs when you are either in a position or you have a pending order. And what you do is you have an order at a certain level. So for example, you may have an order pending at a certain level and then the market moves so fast that it actually doesn't process that order until it slows down a bit. And normally that is quite a bit of difference in price. So then that is called slippage because price slips from your original position where you wanted to get into to a position further away. Now, when does this normally occur? Well, it normally occurs during high news events or data releases. Because what happens is that the market moves so fast that actually your broker isn't able to process your order fast enough. Okay? Because every time you buy, someone else has to sell. So the market order, for example, sometimes you may have your stops above the most recent high, right? And then the market will shoot up. And because it shot up so fast, it wasn't able to close your position at your position that you had it at. It actually slipped higher. Now this happens, but it doesn't happen very often. And if this happens to you, it's just one of those things that happens and it's a cost of business. So don't get too worried or stressed about it. It will happen to you maybe a couple of times a year and it's not going to affect your trading. Compounding. Now, you may or may not know that compounding is one of the 8 wonders of the world. When you really know how to compound your growth, it's like momentum. It just keeps going and going and going. Now, we have a website here where you have a compounded calculator, which will allow you to put in any of your figures that you may have. For example, your starting balance, your every month, what you think your percentage will be, and you'll be able to work out that once you compound, what difference that makes within your account. Now, you have to use the following steps, okay? Select your currency you want to put in. Then enter your base capital and your starting amount. So whatever's in your trading account, say you have £500, say you have £5 million, whatever it is, you put that in there. Then you look at your interest rate and you work out monthly what your average percentage is. So for example, it may be 10%, it may be 20%, and then you put that into the calculator. Then you select months, because obviously we're calculating it per month. You can also use a daily interest one to show you what you would make daily, but just to go off a brief way of looking at it, it's better to go off monthly, because we look at monthly returns, right? That's what we work out in the Forex market. Monthly, quarterly, yearly returns. So it's better to look at it on a monthly process and work it out that way. So this is what the calculator will look like. And as you can see, as you followed it, the person has put £10,000 in. They've put the interest rate across the whole year for 120, because that would be 10% per month. And then they put a daily interval calculator. And this is the results that you get. So as you can see, if you think about it, okay, because they are compounding their growth, rather than making 120% on 10,000, they've actually made nearly 200%. As you can see, you've gone from 10,000 to 33,000. So this just shows you the power of compounding. And the more and more you compound, the faster your account grows. And this is why it's so amazing to use this in the Forex market. Trading View. Most people in our trading community use the Trading View charting package. It makes life very easy and it's very comprehensive charting package. Now, if you are joining our community for the first time, we would highly recommend that you would download the Trading View software.